This podcast is brought to you by the IIEA, sharing ideas, shaping policy.
Good afternoon and welcome to this IIEA webinar with Dr. Leah Rose Ellie Downey at King's College London, who's here to discuss her new book, Our Money, Monetary Policy as if Democracy Matters. This is a very timely topic given what's happening, particularly in the United States, around the long-standing independent Federal Reserve and questions around whether or not it should be as independent as it has been in the past. Also, lots of dimensions to democratic accountability for the central bank that applies to our jurisdiction, the European Central Bank, so may have time to discuss some of those issues. Dr. Downey will speak to us for about 20 minutes and we'll then go to a Q&A. You know how to put your questions via the Q&A function on Zoom. All of the discussion is on the record. If you are putting a question, if you could add your name and affiliation, it would be helpful. Dr. Leah Rose Ellie Downey was a junior research fellow at St. John's College, Cambridge University, affiliated with the Department of Politics and International Studies. She's a political theorist with an interest in the politics of economic theory, economic policy making, and the administrative state. Her current research focuses on democratic politics of monetary policy, and she's recently joined the Department of Political Economy at King's College London earlier this month. So very big thanks for joining us today, and looking forward to both your presentation and the discussion afterwards, Leah. So the floor is yours.
Great. Thank you very much. Thank you to the Institute for the invitation and to Dan for chairing, and thank you very much to Kieran for organizing all this. I will just share my screen here so you all can see my slides. When I started writing this book, central banks and monetary policy were definitely not huge news, and they certainly weren't of huge interest to political theorists, let alone democratic theorists. But now things are changing rapidly, especially in light of recent events in the US and the conflict, as Dan mentioned, between President Trump and the Federal Reserve. So I thought that today, instead of just giving you an overview of the book, which I've got here, I would I'll use some of the substance of the book to make a case to you about the current situation. And then, as you wish, if people are interested, we could get into sort of more of the nitty-gritty theoretical details in the Q&A. But just before we get into that, I thought I'd just give a brief discussion of what's in the book. The book is really the key of the book is the subtitle, right? So monetary policy as if democracy matters, where I consider monetary policy and in particular sort of the institutions around monetary policy making today, most especially in the US, but of course, as the model of central bank independence is pretty universally adopted, it is an argument that travels from a democratic perspective. So the first third of the book is about monetary policy and how it's conducted today, and a little bit of the history of how it's come to be that way in the US. The second part of the book is more political theory, where I talk about how you can have a central bank like the Federal Reserve, which is democratically legitimate, and yet still, in my view, according to my argument, a threat to the health of a democracy over time. And then in the last part of the book, I sort of zoom out and put this in the context of a global financial economy. But just to start today with some of what we're seeing in the US, I want to give a quick outline of the situation between Fed and the Federal Reserve and President Trump with some fairly undisputable facts, right? So before even taking up the position of president, Trump effectively pushed out Vice Chair for Supervision Michael Barr quite early on. There was, of course, the quick resignation of a governor on the Board of Governors in August. We have ongoing threats from the president to fire the chair of the Board of Governors, Chair Powell, with discussions of fraud around the Fed's ongoing renovation. And now, of course, Trump has attempted to fire Governor Lisa Cook, again, arguing that it's a for-cause action with accusations of mortgage fraud. Now, this does seem to me to be without legal basis. I'll leave that for the lawyers to decide, but at least one court seems to have at least tentatively agreed with that view yesterday. And what I can say with complete confidence is that these actions are definitely contrary to the norms and practices of the last few decades. So what exactly is going on here? Well, the first thing I think just that we must say, and particularly I have to say as a political theorist who studies democracy, is that what Trump is doing is not democratic and will not serve to increase the democratic bona fides of the Federal Reserve System. That is, despite what his vice president, J.D. Vance, claimed just recently. In this quote, he was being interviewed on August 28th. He said, I thought the people controlled this country. The people made the determinations in this country through their elected representatives, including the President of the United States. I think that's fundamentally what this is about, therefore suggesting it's not actually about fraud or anything else. Who makes the decisions about this country? Is it those people that we elect, or is it unelected bureaucrats? I feel strongly that the President of the United States is much better able to make these determinations. You can't say that the democratic decision-making process has no influence over monetary policy. That's really, really, I think, an anti-democratic principle. Now, the first thing I think we have to say here, and what seems glaringly obvious to someone who studies democratic theory, and I think many other people, is that democracy is absolutely not about giving more power to any given elected official, no matter who elects them. Centralizing power in one particular individual is, in fact, at odds with many centuries of democratic theory, let alone centralizing the power to create and allocate money. And this, after all, right, is exactly the issue that motivated the Civil War in England, that their centralized power over money was too much, even for a king, let alone a president. And this simple fact has been clear for a really long time. And in particular, it was exactly why the writers of the US Constitution gave power over monetary policy explicitly to the legislature, along with, of course, power of the purse. So I think it's important to say from the get-go that Trump's attempt to take over the Board of Governors at the Fed in pursuit of presidential power over monetary policy cannot be understood as democratic. Now, that, of course, may not be news to many of you, but here's where things start to get slightly more complicated. So when we start to look at what we've seen in the news and in the media over the last few months while all this is happening, have been many, many comments about central bank independence. And I think it's important to say that while Trump's move is not democratic, that commentators' response has tended to be to seek to try and defend the status quo. But the enemy of my enemy is not always my friend, right? So Vance, in my view, is completely wrong in his suggestion that Trump should have singular control over the Federal Reserve. But he's not necessarily wrong about the contemporary structure of the Federal Reserve being at the very least odd and at most clearly undemocratic. Now, I'm happy to come back to the actual details of the Federal Reserve if anyone has interest in that. The private ownership structure and the governance structure, which are they are quite historically unusual. But for reasons of time, I'm just going to plug on here and can come back to that in the question period if people are interested. What's bothered me most about the commentary in response to Trump's attacks on the Fed is that we've seen op-ed after op-ed and discussion after discussion of experts claiming the essential importance of central bank independence and how crucial it is. And this I simply don't agree with. To me, it's important to emphasize that one need not be committed to central bank independence in order to object to Trump's actions. In fact, as I'm going to suggest here, and I argue obviously more thoroughly in the book, a commitment to a healthy democracy over time, in my view, would entail rejecting both. So what I thought I would do today is that in light of all the recent issues in the US is lay out for you some of the strongest or some of the most common arguments both for and against central bank independence. Traditionally, when we hear central banks' independence discussed in the media, usually we hear about the arguments for it, very rarely the arguments against. And most commonly, we hear the arguments for it presented in a way that is rather thin, right? They often take the form, trust me, it's a good thing. So as Jason Furman put it in the New York Times recently, quote, independence is vital. People, from governments to banks, need to have confidence that the Fed is making its own decisions. Otherwise, bad things can easily follow. Now, what I suggest here is that if you start to look more deeply into the matter, things are far from straightforward. So let's start with the arguments for central bank independence. They generally come in two buckets, empirical and theoretical. But to begin with the empirical defenses of CBI, there have been many, many studies over the years, but there are a few that are regularly cited as canonical in discussions of central bank independence. I'm going to mention two here. The first was one of the early studies. It came out in 1993. It was written by Alberto Alesina and Larry Summers, where they claim to have discovered a, quote, near perfect correlation between central bank independence and inflation. The study spanned 1955 to 1988 and included 16 countries, all of which are OECD countries. And even the authors were somewhat cautious in their claims, right? So they pointed out themselves that, quote, the results here are not conclusive in the sense that we have looked at the data only in a very straightforward way. More detailed analysis of the relation between central bank independence and real performance is warranted. And in particular, they mentioned the difficulty of measuring central bank independence and the possibility of endogeneity. Basically, they found a correlation, a pretty straightforward correlation between two variables over a particular period of time across quite a restricted set of observations. And while this is, of course, interesting, as they themselves say, it's hardly conclusive, particularly when one is interested in a causation relationship. The second paper that is considered rather canonical in the literature is one published by Crow and Mead in 2008. And this, interestingly, this paper starts with quite a long discussion of how, despite the theoretical acceptance and wide adoption of central bank independence across the world, really, since the 1980s, quote, empirical studies have found surprisingly limited evidence of independence delivering its promised anti-inflation benefits in practice. They reference the Alesina and Summers paper specifically before pointing out that a large set of later studies that span a wider data set have produced equivocal results. They do go on to conclude, they believe, that they have found robust evidence for a relationship between central bank independence and lower inflation, but only after presenting results that seem to, quote, confirm the puzzlingly weak or non-existent relationship between CBI and inflation found in the literature. They then go on to apply what I see as quite an elaborate set of econometric adjustments. So they seek to distinguish between de facto and de jure independence, and then they apply a set of instrumental variables for governance measures such as the rule of law and voice and accountability. They justify this application because they seem to think that, or as they say, they believe that institutions such as a strong legal system and an independent civil service will influence inflation only through central bank independence, which seems rather implausible to me. I won't continue to bore you with specific details except to just point out that the empirical evidence marshaled regularly in favor of central bank independence is hardly straightforward and can read at times like researchers in search of a result. This is not even to mention the other complicating factors here, such as already mentioned, the difficulty of measuring central bank independence, the possibility of reverse causation, which is mentioned by other econometric studies, including perhaps most famously a study by Adam Posen. And then there's the suggestion in the literature that CBI might actually be best understood as a signaling effect, right? So some have argued, and I think with good reason, that central bank independence seems to emerge maybe as actually a consequence or a signal of a particular governance regime dedicated to policies that are more likely to achieve lower stable inflation, but not a cause of it. Okay, so moving on rather quickly, as we don't have much time, to some of the theoretical defenses of central bank independence. The first, there are a few. The first that I'll mention here is the suggestion that monetary policy is too complex for democratic influence. This, in my view, is not a compelling suggestion, right? First, is monetary policy really more complex than fiscal policy or nuclear policy or environmental policy? It doesn't seem clear to me that it is. And second, and most importantly, it seems complexity would be a good reason to engage experts and expertise in the policymaking process, but it doesn't seem like a sufficient reason to give them autonomy or independence over the matter. Remember that to argue against central bank independence is not an argument to eliminate the central bank and ask the legislature to make policy on its own. Rather, it's an argument for the legislature to exercise effective, active, regular influence over central banks, regularly engaging and steering the policymaking process. Perhaps in the Q&A, we can discuss more specifically about how I see that happening. Now, next, and perhaps most foundational in terms of theoretical defenses of central bank independence, is the idea that monetary policy is time inconsistent. This is the basic idea that what looks like good policy in the short run doesn't match up with what's good policy in the long run. Or more specifically, defenders of central bank independence tend to claim that monetary policy is time inconsistent because of what they refer to as an electoral business cycle. And here the idea is that politicians will want to juice the economy in the lead up to an election, and this will cause damaging inflation in the long run. So short-term policy, loose monetary policy, is not good long-term policy, which the suggestion here would be tighter monetary policy. Now, there's lots to say about this argument, but I'm just going to pick one or two points here. The first is that as in the case of complexity, it's not clear to me that monetary policy is actually unique in this way. Politicians also want to lower taxes, spend lots of money, and or start wars, and much more in the lead up to an election, not all of which are a good idea in the long term. And yet we still think that they should control these policy areas for democratic reasons. I'm just not convinced that monetary policy is meaningfully different in its temporal dimension to these other policy areas. Furthermore, to suggest that voters and politicians are incapable of recognizing this seems also overly simplistic. It is, of course, true that voters and politicians can have short-term biases, but this hardly prevents them from discussing and considering longer-term consequences for policy. Tax policy, of course, is the obvious example. Should a politician in the lead up to an election want to lower taxes, the opposition is obviously there to suggest why that might be or not be a bad idea in the long term. And it certainly doesn't seem reason enough to me, having these sort of potential short-term biases, to insulate such a fundamental state power from democratic control, especially when there's no ironclad connection between short-term monetary policy adjustments and longer-term dangerous inflation. As most central bankers would tell you, we don't have a solid working theory of inflation and time lags. Perhaps most significantly of all, in terms of theoretical defenses, is the proposed solution. So in general, time inconsistency is considered the diagnosis. The solution is credible commitment. So the idea is that since politicians can't be trusted, the legislature should tie itself to the mast, like Ulysses here, to ensure good monetary policy, where the mast is central bank independence. Setting aside whether it is in fact the case that good insulated central bankers can deliver good monetary policy, however we want to define that, the Ulysses analogy here is simply not appropriate. There are a few key reasons for that disanalogy, but I'm just going to mention one at the moment. And that is that Ulysses is tied up. So he can't do anything. He has no need to do anything except for here to listen to the sirens. He has no need to steer or to row or to navigate or to cook or to clean or anything else that might need doing on the ship. A legislature, by contrast, has a lot to do, including pass policies which may themselves influence monetary policy or could be served also by the use of monetary policy. And this is essentially a really essential, important disanalogy because it demonstrates that the trade-off in the case of central bank independence is not so simple as the trade-off in the case of Ulysses. And I'm going to come back to this in just a minute. So just to briefly summarize, the empirical evidence in favor of central bank independence is far from conclusive, and the theoretical arguments, in my view, are themselves rather shaky. They fail to distinguish monetary policy from other areas of policy, fail to define good policy, or offer arguments for why insulated experts are capable of delivering it, and offer overly simplistic claims about why politicians are unlikely to make good choices. Finally, they fail to recognize that in embracing central bank independence, we're not just limiting the legislative power over monetary policy, but hamstringing the democratic body more completely, a point that I'm going to come back to in just a moment. So far, what I've been outlining, and I do discuss to some degree in the book, are arguments in favor of central bank independence, and in particular, I've been suggesting that perhaps they're not as strong as they're purported to be. But whether you're convinced that they're flat out wrong, or maybe perhaps you might just think, oh, that maybe they're slightly weaker than I previously thought, it doesn't really matter. What really matters is what you think of as the balance of the claims for and against CBI. So I'm now going to turn to the arguments against central bank independence, which is really the focus of the book. And I offer two primary arguments here. And you can see them both, again, if we go back to Ulysses. So Ulysses is tied to the mast. This, as I've already mentioned, makes it harder to do other things, which suggests a limitation to state capacity. But also, the longer that you leave Ulysses there tied to the mast, the more his capacity to act as a captain actually wanes. And this, I suggest, is what we're seeing when I make a claim that central bank independence is a threat to the health of the democracy over time. So what do I mean by that? Democracy requires that citizens, directly or indirectly via their elected officials, engage in a form of self-rule, that they're able to guide state power, particularly key powers of the state, such as military and monetary power. As I mentioned earlier, Congress in the US already has power over monetary policy. That remains true today, as it was when the writers of the Constitution made it so. The US Congress could eliminate or change the Fed tomorrow with a majority vote, also suggesting they're hardly bound to the mast. But then we might ask, what's the problem? If Congress already has formal power to change the Federal Reserve or Fed policy, is it not already a democratic system? Well, as I argue in the book, there's a very big difference between formal and effective power. Congress holds formal power over the Fed, but has chosen, by appeal to central bank independence, not to exercise it regularly for decades. This has meant that congressional power to truly engage, to steer, to rule monetary policy has atrophied, as Ulysses' muscles might have done if he'd been tied to the mast for as long as Congress supposedly has. A failure to engage means that the topic has fallen out of public debate. The legislature is not focused on, it's not forced to engage on what could be different or make clear decisions on potential reform, either structurally or operationally. Now, when it comes to state capacity, I am quickly running out of time, so I'm going to be brief here. As I mentioned, I conceptualize democracy as a system of state rule, where the citizens collectively share the power to shape the future. Well, monetary policy is the regulation of money creation. And as most of us here, I'm sure will know, right, access to credit influences the creation and recreation of the physical, social, environmental, and political world that we live in. It is a hugely important tool of state power. It's currently limited to a very narrow aim and insulated from democratic politics. I've already discussed some of the threats of that insulation, but what about the narrowness of the aim? Well, here's where the theory of monetary neutrality comes in. It's a very widely accepted theory in macroeconomic policymaking circles and in macroeconomic theory. And the idea is essentially that money has no real effect on the real economy in the long run, right? All that matters to what we can produce in the long run is technology, capital, labor, the fundamentals of the economy. Money merely greases the wheels of trade. And while it can influence things in the short term, in the long term, it doesn't have a significant effect. This theory, in my humble opinion, is a serious problem and limitation to policymaking because money, of course, has a very important effect in the short run, as economists would agree. It has huge influence over what is produced, where, how, or by whom. But the problem is that the long term, which the theory of monetary policy neutrality is resting on, is an equilibrium condition and not a measurement in calendar time. So the long run, in theory, is the point at which the economy returns to equilibrium after a change or a shock, assuming no interim changes, right? So no interim economic shocks nor policy shifts. But this point, in my view, is likely never to arrive, given the inevitability of shocks occurring all the time in the interim. We are likely never to reach the theoretical long run, but rather live in a series of short runs that are linked to one another. And consequently, money does matter. And thus, so does monetary policy. This is being more widely recognized in scholarly circles. Some economists of the BIS have started to refer to it as monetary policy hysteresis. So just to briefly conclude, Trump is clearly trying to wrest the power from the Fed, and it's worth noting that this is not for democratic reasons, nor does it seem that it's reasons for wartime mobilization, as has been the case in the past, nor does it seem to be for reasons even of class interest, as the global asset holding class to which Trump clearly belongs has benefited greatly from central bank independence since its inception. Rather, it seemed clear to me that Trump is simply someone who has an interest in holding power and money for himself. Again, the king analogy looming large. And since the Fed is the most powerful monetary printing press in the world, he obviously wants to control it. That, I think most would agree, is a bad thing. And we should aim to stop it. However, we should do so with a note of caution. Just because Trump's actions are wrong doesn't necessarily make central bank independence right. And in my view, central bank independence is a threat to democracy, to state capacity to truly engage in truly transformative policy, which we are in desperate need of at the moment. And if we fail to see this, I fear that clinging on to the status quo ante could actually lay the ground for, yet again, more disruptive politics, not less. And on that note, I will very much look forward to hearing your questions.
This podcast is brought to you by the IIEA. sharing ideas, shaping policy.